Welcome back to the deep dive. Today, we have a really fascinating one for you. We're looking at Ganesh. Housing Limited ticker is Ganesh.
Right.
They're a dominant force in Gujarat's real estate market. And we've got a great stack of sources, their latest earnings presentation, some sharp technical analysis, and news coverage on their project pipeline.
And our mission today is pretty critical, I think, because this company is a classic case of, well, a conflict. You have these amazing fundamentals on one side, and on the other, a pretty complex, tricky stock chart. So we need to look past the lumpy quarterly numbers, which are just the nature of real estate,
Always.
and really get at the long-term value, which for them is all about their huge land bank and this massive commercial project, Million Mines Tech City.
And before we even get into the numbers, let's just start with the anchor point, the thing you have to know to understand everything else about this company.
Go on.
Ganesh Housing has been net debt-free for over 3 years. That's more than 12 straight quarters. In a business like real estate that just eats capital, being debt-free isn't just healthy, it's a superpower.
It's a profound strategic advantage. Absolutely.
Okay, so let's unpack those Q2 financials. As you said, they're lumpy. Revenue for Q2 FY26 was about INR 1,743 million.
Right.
Now, quarter over quarter, that's up a decent 15.4%. But here's the friction point. Compared to last year, revenue was down over 30%.
A big drop.
A big drop. And profit followed, down almost 32% year over year. So why shouldn't an investor just see that and, run for the hills?
It's a totally fair question, and it really gets to the unique rhythm of this sector. Real estate revenue isn't like a SaaS subscription. It gets recognized when projects hit certain milestones. So if a bunch of projects finish in one quarter, the next year is naturally going to look weaker in comparison. It's what we call lumpy revenue recognition.
So we just ignore the top line then?
We don't ignore it, but we focus on what it tells us about profitability. And what's really robust here are the margins. The EBITDA margin in Q2 was 85%.
85%. Wait, say that again?
85.
Yeah.
And the profit after tax margin was 62%.
That is jaw-dropping. For a developer, how is that even possible?
That's the secret sauce. And this is where that whole debt-free balance sheet comes in.
Yeah.
Because they've held this massive land bank for years.
Land they bought cheap.
Land they bought cheap, and that's fully paid for. So their input cost is incredibly low. They don't have this crushing interest burden that kills the margins for their competitors.
Yeah, okay.
Our sources point out they've cut their debt by INR 6,500 million since FY19, and they're funding everything from their own cash flow.
So they're bypassing the whole expensive land acquisition cycle, and that flows right to the bottom line. That makes perfect sense.
Precisely. And if you zoom out, management's not worried about one noisy quarter. They're talking about having visibility on roughly 10,000 crore of free cash flow over the next decade.
Wow.
Just from the current pipeline. Those margins tell you that future cash flow is very high quality.
Okay, so let's talk about that future. Historically, they've been about premium residential projects. But now all the talk is about commercial, specifically this flagship, Million Mines Tech City. Explain what this is, because it sounds absolutely massive.
It is massive. This is their core long-term asset. It's an integrated IT special economic zone, an SEZ. It's on 64 acres with plans for over 15 million square feet of development down the line.
So this is a huge strategic pivot.
A huge pivot towards recurring, stable income.
But how far along is it? I mean, a plan is one thing, but a revenue-generating building is another.
And that's the fascinating part. Phase 1 is already 94% complete.
94%.
Fit-outs are expected to start this coming quarter, Q3, which means those lease rentals, that annuity income, should start flowing by Q4 of this fiscal year. This thing is coming online right now.
So who's signing up? Are big companies actually looking at Ahmedabad?
They absolutely are. The traction is already there. About half of the leasable area in Phase 1, that's around 0.85 million square feet, is already under active discussion, or LOIs.
And the tenants?
Mostly global capability centers, or GCCs, some hybrid workspace providers, and big tech firms.
Hold on. For listeners who might not be in this world, what exactly is a GCC?
Good question. Think of it as a company's own internal hub. So instead of outsourcing their IT or R&D, a big multinational bank or tech giant will set up their own center in a place like Ahmedabad to handle it all in-house.
Okay, so we're talking high-quality, long-term, sticky tenants.
Exactly. Impeccable credit profiles. And to get them, you need an exceptional product.
Which this seems to be.
It is. It's not just big, it's premium. It's an IGBC, platinum-rated, grade A++ office tower.
So top of the line for green buildings, energy efficiency, All the things multinationals care about.
All of it. And critically, it's being managed by Tishman Speyer, the global real estate giant. This is their first big project in Ahmedabad.
That's a huge vote of confidence. So this all ties into what the company calls its annuity plus development model. Can you just break that down for us?
Sure, it's a hybrid strategy. The development part is what they've always done. Build and sell high-margin residential units for that quick, upfront cash.
Which keeps them debt-free.
Exactly. Then the annuity part is where they hold on to these huge commercial assets like million mines to generate stable, recurring rental income. It stabilizes the whole business.
So they're de-risking their own business model. That's smart.
Very. And the pipeline backs it up. They just added another big commercial project, 191 Thaltej, that's expected to bring in another 2,100 crore in revenue. The future is clearly a mix of both.
Okay, let's address the elephant in the room here.
Geographic concentration.
Yes. Some investors might get nervous seeing a company so focused on just one city, Ahmedabad. Why isn't that a huge risk?
You know, normally it might be. But in this case, their focus on Ahmedabad is actually one of their biggest strengths.
How so? Wouldn't a bigger market like Mumbai be better?
Maybe, but they'd lose their local advantage. Ahmedabad is the economic heart of the region. It accounts for something like 42% of all of Gujarat's investment. And its proximity to Gifty City. Yeah. That's a massive tailwind.
And what about the actual market demand? What are the fundamentals telling us?
They're incredibly strong. Ahmedabad is ranked as India's most affordable housing market. Think about this. The average EMI to income ratio is just 18%.
18. In Mumbai or Delhi, that would be what, 30, 40%?
Easily. So that affordability just keeps demand consistent. And then you have the quality of life factors. The city was just ranked India's cleanest large city.
I saw that.
Plus you have the metro expansion, the 2030 Commonwealth Games. All of this is driving property values up. The expectation is for 10 to 15% appreciation annually.
And is that holding true in the premium segment where they operate?
It is. That's a key piece of data.
Yeah.
If you look at something called quarters to sell or QTS.
Which is how long it takes to sell the current inventory.
Exactly. The high-end segment, the 50 to 100 million rupee homes, has the healthiest metric. The QTS is just 2.1 quarters.
So just over 6 months of inventory in their core market, demand is definitely strong.
It confirms demand is outpacing supply in their high-margin niche.
Okay, let's talk about the foundational asset that makes all this possible.
The land bank.
The land bank.
This is what guarantees their future. They hold about 524 acres of fully paid land reserves. And it's not random plots, it's concentrated in growth corridors, like Godavari Township and, of course, the Million Mines area.
524 acres, fully paid. That puts a huge value floor under the company. How does that translate into, an actual project pipeline?
It translates into a truly massive runway. Their total development target is around 32 million square feet over the next few years.
32 million.
And if you add up the sales value of the residential pipeline and the capitalized value of the commercial projects, you're looking at a total potential of roughly 172,500 million rupees.
Wow. INR 172.5 billion. But let's go back to that core conflict we started with. Potential is great, but it's only potential until you execute.
Right.
How do we know they can actually build and lease out 32 million square feet? That's a huge step up.
And that's the critical piece that de-risks the story for me. Their track record. They're not just builders, they're innovators. Take their Malabar Exotica project.
Okay.
It was recognized as India's top tech structure for 2023. It even got an endorsement from Prime Minister Modi for its innovative use of precast technology.
Precast. So they're basically industrializing the building process, using modular techniques to speed things up and keep quality high.
Exactly. And that award shows they don't just have land. They have the capability, the technology, and the safety culture to execute these huge, complex projects. It's what gives you confidence they'll hit their leasing goals for Million Mines.
All right, let's make that sharp pivot. The fundamental picture is, well, it's overwhelmingly positive. Low debt, huge assets, great margins. So why has the stock been so volatile? The exchange even had to ask for clarification on unusual volume moves.
It's the classic disconnect. And the technical chart shows you that market skepticism. Right now, the bias is still bearish.
Meaning?
The price has been making lower highs and lower lows. And crucially, it's been stuck below both the 50-day and the 200-day moving averages.
And for listeners who aren't chart experts, what's the significance of that 200-day average?
Think of it as the health line for a stock's long-term trend. If you're consistently below it, the trend is considered unhealthy. In this case, it's acting like a ceiling, just capping any attempt to rally.
But we did see a recent pop, right? A strong green candle, a big spike in volume. That has to mean something.
It shows serious interest, yes, but you have to be cautious. In a downtrend like this, a sharp bounce can be a trap. It risks just becoming another lower high rally before it rolls over again.
So for a more aggressive trader who's tempted by that bounce, what's the danger zone? Where's the floor?
The analysis points to the support zone around 800 to 820 rupees. If it breaks below that, it suggests the downtrend has another leg to go. That's the critical stop-loss area.
And for more conservative folks waiting for a real confirmed breakout, what are they watching?
The key resistance zone is between 950 and 975 rupees. That's where you have this confluence. The long-term downtrend line and that critical 200-day moving average are meeting.
A tough ceiling to break
A
through.
very tough ceiling. It'll take sustained buying pressure to clear it. And you'd want to see momentum indicators like the RSI confirm it.
Right, the relative strength index.
Yeah, for a real reversal, you need to see a sustained close above 925, with the RSI holding firmly above, say, 55 or 60. Without that, the fundamentals are great, but the market might just keep the stock in the penalty box for a while.
So let's try and synthesize all of this.
Okay, to sum it up, Ganesh Housing looks like a high-margin, low-debt, thematic bet on the Gujarat real estate cycle. They have a massive runway and are guiding for double-digit profit growth. But the current valuation, arguably, doesn't fully capture the value of that huge land bank or the future cash flows from projects like Million Mines. The market seems to be discounting it for the technical volatility.
Which brings us to our final thought, something for you to chew on. The company's debt-free status and its immense fully paid land bank provide this huge security blanket, a clear floor for its value.
For sure.
But all of its future growth is completely leveraged on execution. So as you watch the story unfold, ask yourself, which factor is going to be the stronger driver of long-term value? Is it the sheer size and security of those land reserves? Or is it the timely execution and successful leasing of massive projects like Million Mines Tech City?
And that tension right there between the asset security and the execution risk is what makes this such a compelling name to watch.
And that's it for this deep dive. We hope this gives you the clarity you need to navigate this very complex story. We'll see you next time.